Imagine waking up to a sky of fire, hearing the distant rumble of a naval clash, and feeling the tremor in your own bank account as the price of a liter of gasoline climbs higher than ever before. That is not a scene from a sci-fi movie. It is the very real possibility that a showdown between the United States and Iran could send shockwaves all the way to London's financial district and across the whole of Europe. The question we need to ask ourselves right now is, how does a conflict half a world away threaten to upend our daily lives, our savings, and the stability of the continent's markets? In the past few weeks, we have seen a dramatic escalation. A United States drone strike on an Iranian facility sparked a swift retaliation, and both sides have been flexing their naval presence in the Persian Gulf. The tension is not just about military posturing, it is about control of the world's most vital energy arteries. The Strait of Hormuz, a narrow waterway that funnels roughly 20 to 30% of global oil, sits at the center of this drama. If that choke point were to be blocked, even for a short time, the ripple would be felt in every oil-dependent economy, and Europe is one of the biggest importers of that oil. Why should a London viewer care about a naval skirmish in the Gulf? First, the United Kingdom still imports a significant share of its crude from the Middle East, and the City of London is the world's clearinghouse for oil futures. When traders in the city see a risk of supply disruption, they react instantly, pushing up Brent crude, and consequently, the price we pay at the pump. Second, the European Union derives roughly 5% of its oil from Iranian sources, and that share can quickly evaporate if sanctions tighten or shipping lanes close. The moment the market perceives a threat, the price of a barrel can jump by $10 to $15, and that translates into higher costs for households, businesses, and governments across the continent. Let's step back for a moment and look at the bigger picture. The United States has long positioned itself as the guardian of the free flow of oil, because its own economy and its allies depend on it. Iran, on the other hand, has been under a web of sanctions for nearly a decade, and each new restriction pushes it to double down on its regional influence. The current flashpoint is not an isolated incident. It is the latest rung on a ladder that could lead to a direct military clash, a wider proxy war, or even cyber attacks on critical oil infrastructure. History shows us that even a brief interruption in the Gulf can send Brent crude soaring, as we saw during the Libyan civil war and the more recent conflict in Ukraine. Those price spikes were not just numbers on a screen. They meant higher heating bills in Manchester, more expensive flights from Heathrow, and tighter margins for European manufacturers. Now, imagine the scenario where a small skirmish escalates into a full-blown closure of the strait for a few days. The immediate effect would be a surge in oil prices, but the secondary impacts are even more insidious. Higher oil costs push up the price of natural gas, because many power plants switch to gas when oil becomes too expensive. That, in turn, raises the cost of electricity for factories and homes, feeding into inflation. Central banks, already wrestling with the after-effects of the pandemic and the war in Eastern Europe, would have to decide whether to tighten monetary policy faster than planned. A sudden hike in interest rates could tighten credit conditions just as European banks are trying to recover from a wave of non-performing loans. And it doesn't stop at energy. The financial market is a delicate web of interconnections. When oil prices jump, the value of currencies of oil-exporting nations can rise, while those of import-dependent countries fall. European insurers, many of which underwrite shipping and energy projects, would face higher claims if there were a spill or a sabotage incident. Reinsurers would raise premiums, and that cost would be passed on to shipping companies that transport everything from cars to consumer electronics. A sudden spike in freight costs would make imported goods more expensive, feeding directly into the cost of living pressures that many families in the UK and the EU are already feeling. All of this might sound like a distant chain of cause and effect, but each link is already moving. In the past month, we have seen Brent crude climb by $10 to $15 per barrel, and the euro-dollar exchange rate wobble as traders reassess risk. The British pound has shown a slight depreciation against the dollar, reflecting concerns about a potential energy shock. If you look at the bond market, The yield on 10-year German bonds has edged higher, a sign that investors are demanding a premium for perceived instability. These are not abstract numbers. They are the early warning lights that signal a possible storm on the horizon. So, what can you do as an individual, as an investor, or simply as a citizen trying to make sense of a complex world? First, stay informed. The situation in the Gulf evolves quickly, and a single incident can change market sentiment overnight. Follow reputable sources and watch for official statements from both Washington and Tehran. Second, consider diversifying your energy exposure. If you have a pension or investment portfolio heavily weighted in energy stocks, think about balancing it with sectors that are less vulnerable to oil price swings, such as technology or consumer staples. Third, keep an eye on your household budget. If you notice your gas or electricity bill climbing, it might be time to explore more efficient appliances or even a switch to a fixed-rate tariff that can protect you from sudden spikes. What do you think about the risk of a Gulf disruption? Do you see this as a plausible trigger for a broader economic slowdown in Europe? Let me know in the comments. I'm really curious about your perspective. And if this deep dive into the hidden links between geopolitics and your daily wallet is opening your eyes, go ahead and smash that like button. It tells the algorithm that you want more content like this. If you're ready to keep exploring how world events shape our financial future, hit subscribe and join the conversation. In the next part, we'll walk through a concrete what-if scenario, mapping out exactly how a 6-day closure of the Strait could reshape London's markets, affect the Eurozone's inflation outlook, and force policymakers to make tough choices. Stay tuned, because the stakes are higher than ever. Imagine for a moment that the narrow waterway linking the Arabian Sea to the Persian Gulf is sealed off for 6 days. Ships are denied passage, tanker traffic stalls, and the flow of crude that fuels the global market comes to an abrupt halt. The first ripple appears in the price boards at the London trading floor. Brent crude, which had been hovering in the high 30s of dollars per barrel, suddenly spikes into the mid-50s. The surge is not just a number on a screen. It translates instantly into higher costs for airlines, shipping lines, and the countless businesses that rely on petroleum-derived inputs. When the price of oil climbs, the cost of producing electricity, heating homes, and moving goods follows suit, and the ripple reaches every corner of the British economy. In the immediate aftermath, the City of London sees a surge in volatility across a range of asset classes. Energy-focused exchange-traded funds experience a sharp inflow as investors scramble to capture the upside, while sectors that are heavy consumers of oil, such as airlines, logistics, and heavy manufacturing, see their stock prices tumble under the weight of rising input costs. The volatility index, a barometer of market nervousness, jumps to levels not seen since the height of the financial crisis a decade and a half ago. Traders on the floor whisper about risk-off sentiment, and the classic flight to safety begins. Gold, the age-old hedge against uncertainty, climbs, and sovereign bonds from countries perceived as stable, particularly those with strong fiscal positions, benefit from a widening demand for safe haven assets. But the story does not stop at the market ticker. The higher oil price feeds directly into the inflation calculations that policymakers in the Eurozone and the United Kingdom monitor night after night. The European Statistics Office releases a preliminary reading showing that consumer price inflation has jumped by a full 1.5 points, driven largely by energy costs. This acceleration pushes the headline inflation rate well above the target set by the central bank, a development that forces monetary policymakers to reconsider their stance. The governor of the Bank of England, who had been hinting at a gradual tightening of policy, now faces pressure to raise interest rates more aggressively to anchor expectations. In Brussels, the president of the European Central Bank, already wrestling with a delicate balance between supporting growth and taming price pressures, finds herself in a room full of dissenting voices demanding a swift response. The policy response, however, is anything but straightforward. Raising rates too quickly could choke the fragile recovery that many European economies are still clawing out of. At the same time, allowing inflation to run unchecked erodes purchasing power, especially for lower-income households that spend a larger share of their budget on energy. Governments begin to explore a suite of measures to cushion the blow. Some propose temporary subsidies for household electricity bills, while others look at strategic releases from national oil reserves to dampen the price surge. In the United Kingdom, the Treasury debates a short-term tax rebate for businesses heavily exposed to fuel costs, aiming to preserve jobs in sectors that might otherwise face a wave of layoffs. Meanwhile, the insurance industry watches the unfolding drama with a mixture of concern and opportunity. Insurers that underwrite maritime cargo and offshore energy projects see a rapid increase in premiums as the probability of disruption climbs. Reinsurance markets, which provide a safety net for primary insurers, start to tighten capacity, and the cost of covering large-scale geopolitical risks rises. This shift in pricing reverberates through the broader financial system. Companies that rely on insurance to secure financing find their borrowing costs climbing, further tightening credit conditions at a time when the economy already feels the strain of higher energy costs. The banking sector, too, feels the tremor. Large European banks, many of which have significant exposure to energy-intensive industries, begin to reassess their loan-to-value ratios. Credit risk models are updated to incorporate higher default probabilities for firms whose cash flows are now squeezed by rising fuel expenses. The result is a modest tightening of lending standards, particularly for medium-sized enterprises that lack the balance sheet resilience of larger corporates. Small firms, which often operate on thin margins, may find it harder to secure the working capital needed to navigate the price shock, leading to a potential increase in bankruptcies if the situation persists. All of these dynamics converge to create an environment of heightened uncertainty for investors, policymakers, and ordinary citizens alike. One tangible effect that many people will notice in their daily lives is the cost of travel. Airline tickets, which already carry a premium due to the global rise in fuel prices, surge even further as carriers pass on the added expense to passengers. A typical round-trip flight from London to a major European capital that once cost a few £100 now approaches £400 or more. For business travelers, the decision to take a flight versus a train becomes a more pronounced calculation, and the cumulative effect of these choices can influence the demand for high-speed rail services across the continent. Household energy bills also climb noticeably. A family that previously paid a modest amount for gas heating may see their monthly statement swell by a few £100s, a figure that can represent a significant portion of a middle-income household's budget. The pressure to find ways to reduce consumption becomes more urgent, prompting a surge in interest for energy efficiency measures such as smart thermostats, better insulation, and even the adoption of solar panels where feasible. In the United Kingdom, this shift could accelerate the rollout of government-backed schemes that subsidize the installation of renewable technologies, as policymakers look to mitigate the impact of volatile fossil fuel markets on consumers. The ripple effect does not stop at the borders of Europe. Global supply chains, already stretched thin after years of pandemic-induced disruptions, feel the strain of higher freight costs. Shipping companies, which rely on bunker fuel priced in dollars, pass on the increased cost to exporters and importers. A manufacturer in Germany that imports raw materials from Asia now faces a higher landed cost, which erodes profit margins unless the price is passed on to downstream customers. Retail prices for everything from clothing to electronics may inch upward, contributing further to the inflationary pressure that central banks are trying to contain. Amid this complex tapestry of cause and effect, individual investors are left with a set of difficult choices. Those who hold sizable positions in energy stocks may see a short-term windfall as oil prices climb, but the volatility that follows can quickly erode gains if markets begin to anticipate a resolution or a policy response that dampens the price surge. Diversification, as always, remains a prudent strategy. Allocating assets across sectors that are less sensitive to energy price swings, such as technology, healthcare, and consumer staples, can provide a buffer against the turbulence. For those with exposure to fixed income instruments, Paying attention to the credit quality of issuers in energy-intensive industries becomes essential, as widening spreads may signal growing risk. Beyond the investment sphere, everyday citizens can take practical steps to protect their finances. Reviewing utility contracts for opportunities to lock in rates before further escalation can shield households from sudden spikes. Exploring alternative energy providers that offer fixed-price plans may provide peace of mind during periods of heightened volatility. For renters, discussing energy efficiency improvements with landlords can lead to lower consumption and, consequently, lower bills. And for those who commute, considering multimodal travel options, combining public transport, cycling, or carpooling, can reduce exposure to rising fuel costs. The scenario we have painted, while dramatic, is not purely hypothetical. History is littered with episodes where a short-term disruption in a strategic choke point sent shockwaves through the global economy. The oil crisis of the early 70s, the conflict in the Gulf at the turn of the millennium, and more recently, the sanctions imposed on a major oil-producing nation, all serve as reminders that the world's energy system is tightly interconnected, and that geopolitical flashpoints can have immediate and far-reaching consequences. In the coming weeks, analysts will be watching a handful of key indicators to gauge whether the 6-day closure scenario is materializing or remaining a cautionary tale. Brent crude levels, the volume of tanker traffic through the strait, the price of natural gas in Europe, and the yield spreads on sovereign bonds will all be scrutinized. Central banks will be listening to inflation reports, labor market data, and consumer confidence surveys to decide whether to adjust monetary policy. And policymakers in London and Brussels will be weighing the trade-offs between supporting growth and preventing a wage price spiral that could undermine the stability they have been striving to achieve. So, what do you think? If the strait were to be blocked for a week, which sector would feel the pain most acutely in your view? Would you consider shifting a portion of your portfolio into assets that are traditionally seen as safe during energy price shocks, such as gold or government bonds? Or perhaps you have ideas about how households can better prepare for sudden spikes in their utility bills. I'm eager to hear your thoughts in the comments below. The conversation we start here can help everyone navigate these uncertain waters. If this deep dive into the hidden links between distant geopolitical events and the everyday reality of life in Europe has opened your eyes, go ahead and give the video a thumbs up. Your feedback signals to the platform that you value this kind of analysis, and it helps the community grow. And if you haven't already, consider subscribing so you won't miss the next episode, where we'll break down the policy toolbox that governments might reach for in a crisis, ranging from strategic petroleum reserves to fiscal stimulus measures, and assess how effective those tools have been in past emergencies. Stay tuned, because the story is far from over. The next chapter will explore how the interplay between energy markets, financial regulation, and political decision-making could reshape the landscape of European finance for years to come. Until then, keep an eye on the headlines, watch the markets, and stay informed. The world may seem vast, but when a single strait closes, its echo can be felt in the heart of London and across the continent.